Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, learn about their experiences evolving through the financial industry, understand more about their process, the tools and techniques that they use to better understand the financial conditions, and then their outlook, what they're seeing, what they're thinking about, what may be just around the corner for equities and other asset classes. Fun conversation today that I had recently with Jerry Robinson. Jerry's the founder of followthemoney.com. He's based in Northwest Arkansas, and we had a lot of fun. I'd met Jerry a couple weeks ago at the Money Show in Orlando and asked if he would come on the podcast after I had some initial conversations with him. Was just super impressed about how he tries to follow the money. I have a quote from Hamilton, "Follow the money and see where it goes," on my monitor that I've had there for years, just to remind me to focus on flows, to focus on price and how it reflects where investors are rotating their capital. Great discussion about trend following, about position trading, about different time frames and tools and techniques that can help you make sense of the markets. Enjoy this conversation, please, with Jerry Robinson of followthemoney.com. I'm super joyful to be sitting down today with Jerry Robinson. Jerry's the founder of followthemoney.com. Jerry, you and I met at the Money Show in Orlando a couple weeks, and I'm super glad that I'm getting you on the show today. How are you? Things okay?
Great to be here. Yeah, no, it was a great time being out in Orlando with you at the
Yeah,
Money Show, and we had a chance to finally connect face to face, and it was a wonderful experience. I'm looking forward to this.
yeah. You were a pleasure to speak to, and I'm sure people will pick up on that very quickly as we start talking about your process, your background, the markets, all of those fun things. Just to kick things off, for those that are less familiar with you and your work, talk to me
Mhm.
about your journey to followthemoney.com. What was your introduction to trend following, to technical tools? How did that sort of what drew you into that particular approach to investing?
David, I was really interested in the stock market from an early age. Unfortunately, I didn't buy too many stocks when I was younger. Although I've corrected that with my own children. I've helped them do that. But
Good.
I was really interested in the markets. I was very fascinated by statistics and math. So it
Mm,
was just natural for me. As I got into college, I studied economics, and I was very interested in just the overall macro economy. This was many years ago. Then that led me to write a book when I discovered that what I was learning in school wasn't quite matching up, like the textbooks weren't really matching up with the reality of the world. And so I wrote a
mm,
book called Bankruptcy of Our Nation that came out right around the crash of 2008.
yeah.
That kind of changed the whole trajectory for me. At that point, that the message that I had became in demand, and so at that point, I kind of stepped away from the corporate culture, so to speak, and launched out on my own. Launched followthemoney.com. At that point, I began to share how we were trading, how we were investing, and I found there was a great need for you know just basic teaching on this topic. Things we don't learn in school, things we certainly don't learn oftentimes from our own family philosophies, our family financial philosophies.
Yeah.
And so there's just a huge need there for education. That's what we've been doing since 2010. We host a free podcast. We have a members only webcast we do every week. We have a slew of tools and different types of tutorials on our website for our members. And as far as trend trading goes, I think I learned that I don't really remember when I first learned it, but I remember gravitating toward that early on. In fact, I was always more interested in the technical side than the fundamental side. I found the
Okay.
fundamental side to be helpful,
Yeah.
obviously extremely important, but I was much more of a visual person, and so technicals were much easier for me to grasp initially. Although
Sure.
in recent times, fundamentals have become visualized too. There's lots of great tools out there for visualized fundamentals, and so I think. If we had the tools we had now, maybe I wouldn't have just gravitated entirely towards technical because again,
Yeah.
I'm very visual. So,
Yeah.
yeah, yeah.
As a trend following investor, you're in the right place. I guess if you're visually oriented, I'm the same way, right? The moment I saw that
Mhm.
you could visually represent investor psychology and supply and demand and fear and greed, I was completely hooked. So I think you
Yeah.
and I are are kindred spirits that way. I should have mentioned at the introduction, by the way. I'm pretty sure we've been underweight Arkansas on the podcast. I think you're our first guest from Arkansas. You're from Northwest Arkansas, right? Fayetteville.
That's right, Fayetteville
That's
area,
awesome.
beautiful, lovely mountainous area. It's a college town, kind of a funky town,
Yeah.
kind of an oddball city in the middle of this state, but
Right.
it's a great place to raise a family. We really enjoy it here.
That's awesome, and not far from like Bentonville, right? Which is Walmart's and a
Right,
number of like Tyson
exactly.
Foods is from there. Yeah, yeah, right.
So many people who
That's
come to
awesome.
so many people who come to visit are always blown away. You think of Arkansas in your mind, you think, "Okay, I think I know what it's like." And then you
Yeah,
arrive at least in this part of Arkansas and people are stunned. I mean, Walmart's what, like the 8th or ninth largest economy in the world. And
yeah,
so and it's right here in my neck of the woods, and so it's pretty amazing the spillover effect, the incredible prosperity around this area,
yeah.
is pretty disarming to people when they come and visit.
That's fantastic. That's fantastic. So talk to me a little bit more about your process if you could. I mean, on your website you talk a lot about following the trends. That's obviously the most important thing is defining the trends, following the trends. What kind of tools and techniques, what are some examples of the ways that you quantify the trends? You mentioned being a visual investor. What's the
Mhm.
technique or set of techniques that really help you define a trend and follow it for profit?
That's a great question. And what I'll say is that over time, as everybody learns, you have to separate trading from investing. And so
Mm,
when I say these things, I want to let people know that I'm speaking when in terms of trading. I'm putting my trading. I always say I'm putting my trading hat on, or I'm putting my
yeah,
investing hat on, because they really are two different beasts entirely. And so
yeah.
when it comes to investing, I may be a little less trend following. When it comes to investing, in fact, I will often violate trend following to pick up great deals, right? I'll buy into
Ooh,
the carnage or whatever.
sacrilege, Jerry. Wow.
I know
Okay.
it's strange, isn't it? But one of my biggest problems, David, and I think this might be a problem for other people as well, is that I confused or conflated trading with investing early
Mm,
on, and so and because I came in the trading door, not the investing door, I was very non-committal all the time, and I think this hurt me because I had this view that I could outsmart the market because I would follow the market and say, well, when we reach a top and we get that head and shoulders pattern or whatever it's going to be, then I'll just
yeah.
step away. And we know that in technical analysis that usually works, but it doesn't always work. And so what would happen to me is I would get in and out, in and out, in and out with my investments. Okay. Not just my trades, but my investment. And I was
Mm,
approaching investing as a trader. And
yeah.
oftentimes you can approach trading like you're an investor.
Yeah.
Both are completely wrong, And so when I describe this, I want people to know that I'm not talking about my own long term philosophy, but more investing philosophy, but more of trading.
Yep.
When it comes to trading, there's different time frames. Of course, there's swing traders who like to use what we would call the swing trend view. That might be something like a daily chart or maybe even an intraday chart. There's obviously position traders. I consider myself today a part-time position trader. I came in the door back in the late 90s as a day trader. And so I was working at a job that I didn't really care for. I had a friend who was trading. He was day trading, and he was talking about this money that he was making. And I was thinking, well, why am I not doing this? Well,
Yeah.
I'm gonna tell on myself. This is a terrible story, and I hope nobody ever. I say it so nobody repeats it. I didn't have any money at the time. I was broke as a joke. I was working this job that I didn't like, and my buddy was making money. I didn't have any money. So what do I do to start day trading? What do? I go to my credit card. I take out a cash.
No.
No, I'm not kidding. I take out a cash advance, and it's like 20% or whatever, something stupid, And I get the money, and I lose it all. I mean, I lose every dime, and so now I got to pay this back. And my buddy's still bragging about making money. This is the '90s,
Yeah.
and so I have this big fat debt I got to pay back. And so I said, well, I'll just do it again, and I'll certainly make money the next time. Well, fortunately, I didn't lose all the next, and I was able actually hit a couple of singles and doubles, and I was able to start climbing out of that hole. But a terrible way to get started. It put so much pressure upon me. So I would recommend that no one ever do that. That's one of the worst things that anybody could ever do. But quite frankly, it's kind of indicative of the newbie trader who comes in and doesn't know any of the rules. And
Yeah.
so since I've violated every rule that I now teach, I feel qualified to mention them, because I really came in without any kind of mentor, without anybody helping me, anybody holding my hand.
Yeah.
And so I started as a day trader over time. That actually worked okay in the late
Uh-huh.
90s. It was kind of hit and miss, steak and beans. One day you're happy, one day you're down. And then over time, I realized, hey, day trading is not the only form of trading. There's swing trading. So I started doing swing trading. That was around 2005. I started swing trading, aiming for, 1 to 10 day holds or whatever. And I really appreciated that more. I didn't have to be stuck in front of the computer. But over time, usually, I think it was around 2009, 2010,
Okay.
I started realizing that there was something called position trading.
Yeah.
So I kept getting more long term in my approach, and
Mhm.
over time, interestingly enough, it could be just the education that I've had over time, but also with that longer time frame. Of course, I began to make more money. I mean, that's where the money is. Usually, is the longer you can sit in a good trend. And so, position trading is where I fall in today. Most people would describe me as a part-time position trader today. I probably take on, 3 or 4 trades a year at most. These are longer term positions. I've held position trades, for well over a year because I just hold the trend. But when the trend does end, unlike my long term investments, I will get out of the trade.
Yeah.
And the way I do it, David, is and this makes it very simple for me for research purposes. I invest in a portion of my overall assets in the stock market, not all, just a portion of it. And then I invest for the long term. My biggest holding right now is Nvidia. My second biggest holding is Apple. My third biggest holding, I think, right now is Visa. Okay, so those are like my core stock holdings, if you will. Okay,
Sure.
now, when I look at those stocks, instead of trading those long-term investments, what I'll do is in my trading account, I'll trade around those positions. Why do I trade those stocks? Because I know those stocks. I had to research them, I had to
Mm.
invest in them. And so what I do is I kind of trade what I know instead of just trading whatever moves, because then that's
Yeah.
more stress to me. I've realized over time that if I just trade whatever moves, I have to drill down and figure out that stock. What about what's going on? What are the fundamentals? I already know that with my long-term investments. So I own my long-term investments and I trade around them to amplify gains. At least that's the goal.
Yeah.
And I'll position trade around them. So when they enter new position uptrends, which I would describe as a new trend that forms on the weekly chart,
Okay.
then I will ride that bad boy until it gives me a signal to stop. And what that does is it often will soup up the gains on my long-term holdings.
Right.
And so that's what I do. I use a weekly chart for the most part. I really like weekly charts, but I always use other charts as confirmation. Monthly
Sure.
charts I'll look at. I use candlesticks. I like candlesticks as opposed to other. I like all the others as well, but candlesticks are really the ones that I really use, the ones I know the best. And as far as moving averages go, I mean, those are obviously huge on a weekly chart. One of the most important is the 40, which
Hmm.
corresponds pretty close to the 200 on the daily.
Yep.
So I like to use that. That's obviously a very important one to me. When it comes to indicators, I'm a big fan of stochastics and obviously RSI.
Okay.
When you have a monthly chart, David, and you have a stock that is like above 70 on the monthly chart. This is often a place where, especially if you get like to 80 or so, that's where like on my long-term holdings, I will be pruning. For example, like in Nvidia, perfect example right now, Nvidia, which is obviously locked in this massive uptrend. If you look at its monthly RSI, it's like at 80 or it's almost 80. I think it's like just below it. Okay. But when
Yeah.
you go back historically, you'll see that, man, this thing tends to get up to about 80 or 85 and then it usually kind of buckles. Well, past is not prologue, but at the same time, I have found that using those overbought signals, especially on the long-term charts like the monthly, can be really advantageous to know when to lock in some gains.
Mm.
It's the same thing on the opposite side. If I have a long-term holding and the monthly RSI dips below 50, especially below 30, to me, that's where I am definitely going to be adding more to that long-term position. So I use RSI a lot. I use stochastics a lot, moving averages, of course, but
Yeah.
there's also the fear too of just getting bogged down with too many indicators. And I see a lot of people I coach kind of get
Yeah.
bogged down in it. So I try to keep it light. I try not to use too many tools, but at the same time, I always use confirmation tools of some kind.
Jerry, in one brief commentary there, you hit on so many wonderful investing nuggets of wisdom, I would say.
Thank you.
Um, Keep it simple at the end there, right? I mean, just
Yeah.
simplifying. And I found the exact same thing. 100% agreed, right? People, especially when they're learning about technical analysis, I find they love to overcomplicate. And so when I work with people, the first thing I'm trying to do is sort of shed some of the noise and just focus on
Mhm.
the signal, right? Focus on what's really helpful. You had mentioned, this idea of multiple time frames and often a mismatch between, am I a position trader? Am I a long-term investor? Am I a swing
Mhm.
trader? Am I a day trader? How you answer that question should dramatically change the tools and techniques I think that you're using, or particularly how you're using different charts. And I've often found that mismatch where people think they're one type of investor, but the tools they're using would argue they're a different type of investor. That
Sure.
that usually doesn't end well. But I would say, I mean, 100. I think one of the most important things you mentioned was how the market cycles tend to operate, and the data would 100% support what you agreed with the idea that as a long-term investor, you're usually better off being more of a contrarian, right? And
Mhm.
betting on things that are completely out of favor starting to improve, and things that are
Mhm.
deeply undervalued over multiple years tend to do quite well in that next big cycle higher. But trend following works remarkably well on that kind of medium term or shorter term time frame.
Mhm.
So,
Yes.
again, I'm not surprised that's sort of where you ended up, and I love your cautionary tale at the beginning. I always tell people try to make mistakes when there aren't too many zeros
Mm.
included in your account. It sounds and
Indeed.
definitely not. Don't borrow money to make those mistakes. But I'm
Mhm.
glad you survived and thrived through those
Yes.
formative times. That's awesome. So you had mentioned your book, which came out sort of late 2000s, going into 2010. It was called Bankruptcy of Our Nation. I'm curious, if you, and I don't know if you have another book on your mind, but I'm wondering if you wrote an addendum to that book today, 15, 17, 18 years later, what has changed? Because obviously a lot's changed in so many ways since then.
Mm.
But particularly in the book, you talk about, I think, what it was called a pace investment strategy, right? Precious metals, ag, and sort of looking at alternative assets. I'm wondering
Mhm.
how those sorts of thoughts, how could you reflect on that now in 2025? Still very relevant. Has your approach that you outlined in the book changed since then? How would you describe that?
It's a great question. Yeah, that book, when I look back, I think everything that we do, whether it's a podcast we did 5 years ago or a video we did 10 years ago, we look back,
Yeah,
we could always critique ourselves. We could always say,
sure.
there was, and in fact, I had a chance to update the book back in 2012, and we had an updated and revised edition. But even that
Nice.
one, I would still revise that today, of course, so how has it held up? Well, I think pretty well. I mean, at the time when I wrote that book, the national debt, David, was less than $9 trillion. Okay, $9 trillion.
Right.
Today it's at 38 trillion. Uh,
Yeah.
at the time I wrote that book, the um, they're really, in fact, I'll tell you something that's crazy about that book. When I wrote that book, this tells you that what the thinking was. The publisher who actually published that book, um, I, I had debated for a long time what to call it, and I think I had
Mm,
finally settled on the bankruptcy of America. And when I talk about bankruptcy, it's not just the fact that we obviously are borrowing Peter to pay Paul. It's obviously a financial problem, but we
yeah.
have, it's like a moral bankruptcy, just kind of like a cultural
Mhm.
bankruptcy. Like we're just kind of, we're kind of at the end of an empire, if you will. It looks very similar to the ancient times that we've seen different empires that have fallen. And so that's kind of the crux of the book. Anyway, when I wrote the book, the title was A Bankruptcy of America. When we went to the publisher thought this is very risque to say bankruptcy of
Mm.
America. And so they actually said, let's call it bankruptcy of our nation. That'll take the edge off of it. Today, of course, the caustic language in the culture is like off the chart. So it shows you how much things have changed since
Things
that
have
time.
changed so much, right? Yeah.
People truly know what's going on. I mean, even the advent of Bitcoin. At the same time I was writing that book, David, talking about the fundamental problems of the economy. there was somebody else looking at the same exact thing, the fractional reserve banking, the national debt, the deficit spending, and he was writing a white paper on Bitcoin. So we were at the same exact time. There were, I was doing this, somebody else somewhere else, we don't know who it is, was doing that. And ultimately, Bitcoin became something that I would have included in the book at the time. Fortunately, I learned about Bitcoin in 2012. I was able to get in early. Same thing with Ethereum. I was able to learn about that early because I look for these things that um, offer promise against our debt-based economy, and
Mm,
that's why I've been holding gold for a long time. Gold was one of the things that you mentioned. Pace, precious metals. I don't get in and out. I just buy and have a core position
yeah.
in gold. I like physical gold for the long term. I don't have a whole lot of opinions about it. I just hold it. The same thing with Bitcoin. I don't have a ton of it. I mean, I know what it is, but I just hold it. And over time, that's really worked out. Instead of just getting in and out of these assets that are really designed to protect us from the debasement trade, over time, these things I think are going to continue to do very well. So I think the best thing a person can do out there, especially if they're very heavy into stocks, is to sit back and think to themselves, what other asset classes are there?
Right.
I know stocks very well. I've been trading them for a long time. So you might say, well, put all your money in it. No, I'd rather have other things. So I have gold, I have real estate, I have my own
Mm,
businesses, I have stocks, I have digital assets, I have hard assets, and so I think it's important to diversify. So today, even with my knowledge, and I teach people and all of these things, I have, uh, you know, on average, 30% or so of my total assets in stocks. And that's
yeah.
all. I don't want any more. And
Got
it
it.
helps you sleep at night too. If you're over
Yeah.
leveraged, then then you don't have peace. And to me, peace is worth more than all the other things combined.
Beautiful. That's a beautiful ending to that whole sentiment. I really like that, Jerry, in so many ways, and I love that idea of the long term play. Thinking of some of the, I mean, things like digital assets. I think so many people think of it as a short term,
Mm,
noisy, volatile space instead of just thinking about the long term, opportunity. And
mhm,
with gold as well. I mean, I don't know if I definitely did not have gold and digital assets both thriving during similar periods, but
mm,
that's indeed what we've seen here.
mhm,
You'd mentioned earlier with the equity portion of how you're invested. You mentioned particular examples like Apple, Nvidia. We're at a point now, early November of 2025, where a lot of people that certainly have been owning them, hopefully off of the April low, are getting really nervous. There's a lot of discussion about overvaluation, that these things have run too far, it's too narrow. How does that, sort of, I guess, frame, or how does that narrative fit into your approach? Is that
mm,
something that would, or is there something you would see or hear that would cause you to trim positions, change positions, or
mm.
is it more about the trend is working until it doesn't? Let's stick with the trend. How do you navigate as a trend follower through a period when people are just incredibly fearful? I feel like that these trends have now played out. Does that make sense?
Yes, of course. Yeah, there's just a lot of noise right now,
Yeah.
especially about the AI bubble or whatever.
Yeah, yeah,
If you look at the S&P, and people can argue, good people can argue about these topics. And but when I look at the S&P 500, I see the PE ratio is currently around 30.
yeah,
That's It may not be super cheap, but at the same
yeah.
time, it's
It's
nowhere
not
near.
horrible, right?
No,
Yeah,
no, it's not,
yeah,
it's not anywhere near like the dot-com levels or whatever. And if you
yeah,
look at like Nvidia, or if you look at Google or whatever, you look at these companies, Apple. I mean, they're printing real earnings. I mean, we're not. This isn't the dot-com era that we're in now. Is there uber excitement? Is there froth? Of course, there's always going to be that. But I'm of the opinion, David, and I could be wrong because opinions are worth a dime a dozen. But my opinion, based upon what I've seen in the past, based upon the charts that I read today, based upon my gut instincts of what I know, um, I'm of the opinion that we have a long stretch to run before we really get into what we would call bubble territory. And
mhm,
I think we probably have at least another couple of years or so. Let's keep in mind too, David, that a function of the market, one important function of the market is the liquidity. And it appears that over the next, 12 to 18 months, especially, we're going to see a lot more easy money. than we have over the last several years. And so I think there's a lot of things that are kind of coming together that are causing that nervousness. A lot of
Mm,
that nervousness, David, may also be from people who missed out. I mean, let's not forget that professional money managers this year are having one of their worst years they've had in decades. Why? Because they underestimated the rally. They overestimated the tariffs. And, who can blame them? I mean, they made their decision, but the point is now they're playing catch up. And so they might want to say it's a bubble and we should, so it's understandable that people who missed out would say that. But people who are in it, you might say, well, they might be, a little blind to what's going on. I guess that's also potentially true. Um, but the way I view it is that if I don't want to be in stocks, well, then I shouldn't be in stocks, But if I'm going to be
mm,
in stocks, then I got to be ready for the pullbacks, and I should be
yeah,
understand what that means. I mean, so if
yes,
Nvidia pulls back tomorrow 30%, I'm going to be a buyer, not a seller here. I mean, that would be the last thing I would do. I wouldn't be selling unless they were down 30% because they were going out of business. Okay, that's different, but that's not usually what happens. These
yeah,
companies get hit with fear, and fear to me is what I crave the most when I go into the market to take advantage of things. When I want to have opportunities, fear is it. So, for example, perfect example, yesterday, I want to date this podcast, but yesterday we had a big rout in the crypto market. And so those are the days that I like to go in and buy, right? So I went in and I bought like I added to 4 positions that I had already. And I was glad to buy. I'm happy to buy on those down days. If you asked that to me, David, 10 years ago, I would have been, very fearful, like most people.
yeah,
And I think what happens over time, David, because I started, in trading in the 90s. I mean, I've been doing this for 30 years now. And it's crazy to say, but the point is that you kind of get calloused. That's the best way I can describe it, David. And you know this, and you've been doing it a long time. You get calloused.
yeah,
I don't. In other words, if I have a great day, some days I'll look at the stock market, I'll look at the crypto market, I'll look and I'll see what I made that day. In the past, I would have been spiking the football, taking people out for steak dinners, bragging, talking about how great it was. And then sometimes I'll look at my stocks or my crypto and I see it's down and I'm like, wow. But when I think back 10 years ago, I would have thought I was the biggest loser in the world. I would have thought that I was the worst trader, right? All these
yeah.
emotions, right? And this is something you speak to so well with your website and your service, market misbehavior, is that it's really all about the psyche. And so today, um, if the market goes down, it goes up. I don't really feel anything, and I don't know if I don't know if
Mm,
that makes sense to a lot of people listening. Maybe they feel the same way, but I don't really feel it anymore. So when it goes up big or it goes down big, I've lost that love and feeling, so that I don't have it. But I do have the feeling of I want to take advantage of this. Um,
yes,
so I still have that, but I don't. I
yeah,
just don't. I don't get whipped around by the emotion. And part of that, David, is I stay off of social media. I keep the financial
mm,
media off. I used to think the financial media was my friend. I used to think it was going to help me. I used to think social media might be a service to me. I now realize that you know, it's not what I turn to. I certainly don't turn to that. I look at the chart. We have a website called followthemoney.com. We follow the money. We don't follow the noise. We don't follow the opinions. We follow the money. And the data doesn't lie. I mean, at least we hope it doesn't. It's all we got. If it's lying, we're in trouble because it's all we have.
yeah. Oh man, that was awesome. I really appreciate what you talked about on a big down day, feeling that opportunity of
Mhm.
basically getting a 5%, 10% off coupon on a great stock or on Bitcoin or whatever it is. I'll never forget in the depths of the financial crisis, I had moved to Fidelity up in Boston. And I was expecting on a big down day, all the portfolio managers to be just absolutely crushed, despondent, feeling the weight of this horrible market. And there were a lot of smiles. And I asked the one, portfolio, like, why are you so excited? Like, we're getting crushed. He said, I just got a 30% off coupon. I just got like a Bed Bath and Beyond coupon on these exceptional companies that I know are going to do well 5, 10 years down the road. He's like, this is great. And they were
Mm,
thrilled to be buying on weakness. And then years later, reflecting back, I realized the wisdom of that.
mm.
In the moment when it feels like you don't want to buy, that's when, if you can switch your frame of
Yes.
reference. Jerry, it's you strike me as you're talking through losses, challenges, volatile market environments. you come across as cool as a cucumber. Like this, none of the what many I think struggle with probably affect you or appear to.
Mhm.
Would you say are there tools and tricks that you have developed or that you've learned to embrace to manage the mental game of trading, the mental game of
Mm.
investing? Or is it just part of your personality? You feel like you have a personality type that is well suited to navigate this because it's not for everyone. What can you tell people? Because I know many people struggle with this in particular, avoiding the emotional anguish of wins and losses.
Sure. Yeah. No, I would say my personality is probably not geared toward this because again, in the beginning, I was an emotional wreck, when I would have a
Yeah,
good day or a
yeah,
bad day. So no, it was learned. It was learned through a lot of hard knocks. I wouldn't want
yeah,
people to take my path. I mean, I had to make a lot of dumb mistakes. I mean, a lot of dumb mistakes. I wish I had somebody to hold my hand early on. I just didn't have it. And I and,
yeah,
and I probably wasn't smart enough to think that I needed it. So you kind of
yeah,
learn it later, but I've been through so many downdrafts over time, and many people have, and some people have been through those same things, and they haven't learned from them. They still feel the same.
yeah,
I guess I just learn from them. One of the things that as I mentioned a while ago, is I don't rely upon social media. I don't consume a bunch of media at all. That's something that I started probably about a decade ago, uh, and I'm just getting better and better at it. I think just tuning that stuff out makes me kind of ignorant as to what they're worried about, and so I think that's part of it. Another
yeah,
part of it is, and I don't want to get too deep in the woods of meditation, but I think that meditation is one of the most powerful things that helps me with this. Is
yeah,
I wake up in the morning, I kind of have a routine, and starting off with meditation and kind of getting yourself centered and being mindful throughout the day, just and then turning off the media as well. I mean, it's a great combination. And so I think it just takes a lot of work. It takes a lot of time.
yeah,
Hopefully not as much time as it took me, but there's people out there who we've coached and we've seen them be able to overcome these things, where they to have the mental capacity to be able to embrace fear without getting caught up in it. Um, I don't want to sound like it's a robot because the minute I say this, I guess I could give in to some sort of fear, but at the same time, we've had many years now of successfully navigating these markets, uh, and keeping our minds cool throughout it. And I think also perhaps maybe like you, David, because I teach on these topics, it's like
mm.
if I don't practice what I preach, then what am I doing? So I guess I have that accountability factor too, where if I'm
Yeah.
not doing what I teach, then that's not right. So there's a
Mm,
lot of factors for me. But for the average person out there, I think they could really benefit from learning technical analysis and spending a little less time on the media, and
yeah,
trying to find some quiet time for themselves. It's such a noisy world. It's so
yeah,
noisy. And when we
yeah.
can just find a little bit of quiet and center ourselves, it's amazing what can we can do with that.
Jerry, that's so beautifully said, and it strikes me as you're describing your ways of addressing the emotional challenges by turning off media, by unplugging a bit from social media. You're turning off the noise that's around you through something like prayer or meditation. You're turning off the noise inside your head, or at least learning to live with that in a positive way. That reducing the noise is the consistent theme, and I 100% agree. I will never forget when I went on a trading floor and they had it was some financial television, but they had it all muted. And I assumed that these guys trading nonstop would just have all this thing, and they're like, it's just noise. Like I don't need that. Like we have
Mhm,
it up just in case there's like the big font something happens we need to know because this was a
mhm,
number of years ago. But it struck me they were intentionally unplugging a bit from
mhm.
just the noise of it, just to focus on what was happening on their screens that they felt was actually the information they needed to focus on.
Mm.
And yeah, I love your comments about meditation there, Jerry. The next time you and I get together, maybe on a different podcast, we'll talk about meditative practices because I'd love to dig more into that. But
Love
for now,
that.
I think your comments are well said. Jerry, this has been such a pleasure. I mean, what a joy
Mhm.
to sit down with you. I really enjoyed meeting you in person. You're a pleasure to speak to, and I can't thank you enough for sharing some thoughts with the audience today. Thanks for coming on the show.
Oh, my pleasure. Thank you so much, David.
It was a lot of fun. Thanks again to Jerry Robinson joining me here on the podcast today. I really appreciated his sort of the way he described his journey as an investor from day trading to swing trading to position trading. It felt very familiar because I remember setting up my Daytech Online account, probably 2000, early 2001, daytrading.coms when I was supposed to be working, and eventually found that was not the right time frame for me. Just you had to focus so much on moment to moment movements, and it always felt like I was a little behind. And then I remember going more to a swing trading time frame and really focusing on that as the main way to trade. But over time, as I've, had a family and I'm thinking about college and healthcare expenses and all the things you have to, figure out as you evolve and as you grow as an adult, position trading, long-term investing started to be more and more the most important time frame I was focused on. But really thinking about how technical analysis can be impactful on each of those time frames, I think was an important takeaway from this conversation. I love the reference to Peter Lynch, trade what you know, thinking about the stories and themes that allow stocks to grow over time as they grow earnings and as they grow in price, but using trend following as an important complement to that. I think that was really, really good. The idea of keeping it simple is certainly resonated for me as well, and that's something I remind a lot of my Market Misbehavior Premium members to reflect on. When we talked about his process of trend following, again, a lot of really interesting points that I think he made about the tools he uses. Very similar, very familiar indicators that many of us use. I like his commentary that came from his book Bankruptcy of Our Nation. He talked about pace investment strategy, precious metals, agriculture, commodities, and energy. I'm wondering here in November 2025 if we're at that point where the AI trade takes a big step back or a big breather, at least stops dominating all of our thinking for 1 minute. I'm wondering if those pace kind of areas start to do well. I mean, precious metals arguably have been doing well for a while, but energy has been lagging, maybe starting to turn higher in Q4 of 2025. Agriculture, kind of an interesting place to be. Soybeans are actually breaking out pretty well. So that stuck with me as well. End of the day, I think my conversation with Jerry, he asked him toward the end about his mindset, because he just has this very calm and thoughtful way of describing what's happening in the market. And I love how he talked about mindfulness. He talked, and he and I talked off camera a lot more about meditation, prayer, sort of those mindful practices we can have to center ourselves so that we are not so affected by big movements in stock prices later in the day. And that is something that I have, definitely hits home. It's something I've tried to work on. That's the whole idea of talking about mindful investing in my own firm came from my experiences, early experiences with meditation, which kind of came in the 2000 teens as I was dealing with being at a big financial firm, going through the financial crisis. And we had a meditation consultant that came around. I remember taking a 6-week class with her, and it was life-changing. I learned things that I still to this day apply every week to try to be more mindful and more meditative and more deliberate with my thoughts and actions. So really glad that we finished the conversation there. Great takes, great observations, and a lot of good thoughts about process there. So thanks again to Jerry Robinson of followthemoney.com for joining me. We'll have a link to his book in the along with the description if you want to check it out, and I would encourage you to do so. Some really thoughtful takes on macro themes, but also trend following approaches and discipline. By the way, if you want to learn more about some of the tools and techniques that Jerry was talking about that he uses to follow trends and that I use all the time to follow trends as well, our Market Misbehavior Premium memberships may be a great way for you to supercharge your own decision making this month and for many months to come. 3 great benefits of the premium membership. First off, you'll have access to all of our virtual courses like Flight School Behavioral Investing, where I'll teach you all about behavioral biases and how we can use technical analysis to minimize them in our process. Second, you have access to our member-only reports like our weekly flight plan, where we focus on what we learned from the week that just happened, what was new, what was different. We look forward at the week to come. What levels, patterns, signals are we watching for? Finally, you'll have full and immediate access to our member community. If you like asking questions, it is a great place to be because you have a small and mighty group of like-minded investors navigating the markets learning about charting and technical analysis, asking questions all the time. I'm into our community every day, checking for questions, sharing brief videos and charts, and just trying to encourage people to improve their decision making and their journey toward more mindful investing. If that is something you want to do in your own investment process, you can find more info at marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That'll do it for today. For Market Misbehavior, I'm Dave Keller. Thanks for joining me here today. And remember, it's always a good time to own good charts.